Thank you very much for joining us here on Urban Debate on Mirror Now. I am Heena Gambhir. Is Indian rupee all set to cross 80 against the dollar? What does it mean for Indian economy? Why is Indian rupee falling against the dollar? Should you be worried? Well, that's our big focus on Urban Debate tonight, as Indian rupee today closed at an all-time low of 78.05 against the dollar, after hitting a historic level of 78.29 against the dollar. It's good news for exporters, bad news for importers. The reasons are many: rising oil price, high inflation, rate hike in the US and other parts of the world. But for someone planning to travel abroad, for someone planning to study abroad, for someone planning to travel to a foreign country for some medical treatment, this weakening rupee is not a good news, as all this is going to get expensive. So should you delay your plans? Or is this weakness in the rupee that we are seeing, in the Indian currency that we are seeing, temporary? Let's try and find out on Urban Debate on Mirror Now this evening. Joining us on the broadcast is Dr M Govinda Rao, Chief Economic Advisor, Brickwork Ratings; Sunil Sinha, Principal Economist and Director, Public Finance with India Ratings and Research. We also have with us Sanjeev S, Ahluwalia, Advisor, ORF; Anil Kumar Bhansali, Head of Treasury, Finrex Treasury Advisors. Appreciate all of you, gentlemen, for joining us here on Urban Debate on Mirror Now this evening. Good to have you on the show today. Dr. Rao, let me begin this discussion with you. Simple question. Rupee is getting weak against the dollar. What does it mean for people in this country? What does it mean for Indian economy?
Rupee weakening against the dollar is, it's not it's an effect of something else. The effect of, your balance of trade, and it's an effect of your, foreign institutional investors taking the money out. And obviously, when you have this type of a situation, and your fiscal numbers are not very good, your macro numbers are not very good, on top of it, your balance of trade is pretty bad. And in fact, in May, you had a balance, the negative balance of trade of something like $23.3 billion. And then this has continued to be the case. Obviously, the imports are much more than the exports, and particularly the oil price increase has been a major factor. And there are also a number of other things like fertilizer or edible oils and various other things. So obviously in this situation, weakening rupees, cannot be avoided. And nor is it appropriate for us to prevent the weakening of the rupee, because at the end of the day, you need to balance the trade and ensure that your current account deficit does not go out of hand.
Okay, we can't prevent it. That's something important. So where is it headed, Mr. Sanjeev Ahluwalia?
Well, look, I think you should really ask a trader that question. But what the traders tell us is that in 2 years' time, this is a dynamic situation. We don't control the rate at which the rupee is valued in the international market. It depends on what all the stakeholders, many others, investors, importers from other countries, and so on, what their view on the rupee is. The only thing India can do is to control its own economic fundamentals, right? So I think what the general news on the street is that in 2 years' time, you should expect rupee to be at 80 plus, right? Now, is that a hugely bad thing? Well, yes, for the very, very few people who can actually afford to go abroad for treatment or who can go abroad to study, I don't think this is a massive problem, because, whatever they're losing on the depreciation of the rupee, they can surely make up in terms of what they will gain back as a student when they earn abroad, Or, if you're going abroad, you obviously have the means to go abroad. You can take that very marginal hit. However, I would like to say that, look, there are 4 reasons what determine the value of any country's currency versus other countries. One is your currency can depreciate if there's a massive speculative attack on the currency, the foreign hand, as we like to think of it. Now, I don't think there is, if you remember in 1997, Mahathir Mohamad, who was then president of Malaysia, accused George Soros, a trader, that he was deliberately marking down the value of East Asian currencies. Now, I don't think that's the situation at all in India. The other reason can be that your government is irresponsible and they're spending much more than what they earn. Now, I don't think that's the reason, because government of India has been very, very financially prudent. So I don't think that's the reason. There can also be that you have a weak domestic economy. And I think this is absolutely true. Even before the pandemic, India's economy was weak. If you remember, we ended at the last quarter before the pandemic at 3% growth. So now, the pandemic hit us, and now we will have to work to get over that initial handicap, which we have inherited. And the last thing is global uncertainty. And I think this is the primary reason why you see this weakness in the rupee. The more global uncertainty continues, the more investors which they perceive to be sound. Now, imagine, this is a psychological thing, because investors will flock to the dollar, right? Whereas I don't think many investors will flock to yuan in China, because they don't perceive the economy of China to be sound, credible, and transparent. Now, these are factors that they associate with the United States. So they flock to the dollar. When they flock to the dollar, they sell assets in India, they reduce exposures in India, increase assets in the United States. So obviously, when there's an outflow of dollars, the value of the rupee falls, and that's the primary reason that is affecting us today. But the second reason is global uncertainty. What is happening in Ukraine? How long will it go on for? Will it explode into something bigger? Remember that in the event of a global uncertainty, all economies which are considered weak, not strong, not resilient, they will all suffer. And I'm afraid India at the moment is not considered as a very strong economy. It has a lot of potential, but it also has inherited a lot of problems which we have yet to get over.
Yes, interesting. Outflow of dollars. We know already how $24 billion have been pulled out by foreign investors from our equity and bond markets, from January this year. Mr. Sunil Sinha, now this is expected to continue this week also. The expectation is US Fed will increase the rate further, making US market more attractive for foreign institutional investors. So does it mean that we should be prepared for further weakness in rupee against the dollar? And what does it mean for people like, the viewers who are watching us today? Of course, the issue of foreign travel, getting medical treatment abroad and education abroad is one thing. But for a country like India, which imports 80% of its oil needs, we have to pay back in dollars. All that is, indirectly going to impact us, pinch our pockets.
Rupee weakening against dollar simply means that the imported inflation component will become even greater for the Indian economy. I mean, as you rightly said, 80 to 85% of our oil needs are actually met through import. So if rupee weakens against dollar, and most of the oil purchases are in dollars. So for the same amount of oil import, we have to pay a much higher dollar. So this is something which is eventually will reflect in the domestic economy in terms of higher rate of inflation. So that certainly is, I guess, the most challenging aspect of rupee weakening against dollar. Now, so far as the trajectory of dollar vis-a-vis or rupee vis-a-vis dollar is concerned, my own view is that, look, I mean, typically rupee has been depreciating against dollar to the extent that we have the inflation rate differential between the Indian economy and the US economy. Say, for example, if the rate of inflation in US is 2% and in India is 7%, that means that there is inherent tendency in rupee to depreciate against dollar because the same amount of rupee will not be able to buy the same amount of dollar. So that was the inherent weakness. However, right now what is happening is that particular aspect is not playing out because the inflation in US is also at a historically high level. So 7, 8%, 9% is inflation in US, and even we are at 7%. So to that extent, that is not what is driving the depreciation of rupee. What is driving the depreciation of rupee at this point of time is suddenly the oil import bill, edible oil import bill, fertilizer import bill. All of these have gone up simply because of the global uncertainty caused by the Russia-Ukraine war. And net impact has been that our higher import bill is not equally matched by our higher export. So in a way, we have a trade deficit, which used to a large extent, compensated by, software exports and the remittances. But still, some amount of gap used to be left, which used to be covered up by the capital inflow in the capital account. And that is what is not happening. On the contrary, as you rightly said, roughly around 24 billion US dollar has been pulled out of India since Jan till about recently. So all of this is ultimately driving the rupee down.
Factors clearly we have now understood that are driving the rupee down, and we want to also spend a little bit of time in understanding where is it headed, what is going to be the correct value, and we as people of this country, how exactly are we going to get impacted. Mr. Anil Kumar Bhansali, now I want to understand from you. I was just looking at some data. So it took rupee around 5 years to reach from 60 to 70. Now, in 4 years, it's going to hit 80. I mean, given the way it is moving ahead, do you think RBI's intervention is not really working, and this free fall is going to continue if we see a rate hike by US Fed this week as being factored in by markets?
One of the reasons for the fall of rupee is the shrinking of the interest rate differential between India and US. Earlier, India had a difference of, say, 5%. Now that differential has shrunk down because the inflation levels have shrunk down. And US is going for a higher rate hikes than India. US may be hiking by about 1.5% in the next 3 months. Probably by September, it will be 1.5%. But India may not be doing that. So one of the reasons is the shrinking different interest rate differentials and the inflation differential also. Now, as regards target of rupee, obviously RBI has been supporting the rupee for quite some time now. At 77.70, they had been for the last 15 days they had been selling at 77.70 and ensuring that it doesn't depreciate beyond a certain level. RBI governor was on record to say that he doesn't want a very fast, and he doesn't want actually a run on the rupee in one of his interviews. So it's quite obvious that RBI doesn't want a fast depreciating rupee, and therefore today also they at 78.25 when rupee reached 78.25, they started selling dollars and ensured that rupee doesn't weaken beyond what it has already done. So it was a 40 paisa weakening. They ensured that it comes back to a 78.03 levels, where it closed today. Regarding the target, now you just can't give a target.
Okay.
You have so many uncertainties. And the war continues. Oil prices keep moving higher from here, and most of the targets for oil prices are near about $150. So if oil prices keep rising in this way, we our current account deficit, our trade deficit, which is already very high. Last year, we had a trade deficit of $140 billion. This year, we are having a trade deficit of $192 billion. And this year, it's going to be quite high. 22-23 will be quite high. So with trade deficit increasing, there is no reason why rupee doesn't in fact, rupee appreciates. It has to depreciate. It has to compensate. Well, another one reason that I would give here is the yen is actually weakening. If you see, the yen has weakened by about 17% from January. It was at 115 levels. Today, it is 134. So rupee, Asian currencies are weakening. Yen is weakening. We have to compensate for that. Our exports have to increase. We have to ensure that whatever imports we buy are continuously supported by the exports that are there. So all these factors together clearly point out that rupee has to weaken. Where it will go, it's to be decided by the RBI.
Okay, where it will go, of course, that will be decided by the Reserve Bank of India. But Dr. M. Govinda Rao, does it mean that if this weakness continues for some more time, inflation level will further go up? Today, of course, we've got some decent news as far as inflation is concerned. In the month of May, it eased slightly the retail inflation to 7.04%. It did not breach the 8% mark, thankfully. But if the current situation continues, do you see inflation further rising in the country because of this? Because the companies that are importing products from outside, importing raw materials from outside, they'll have to pay back in dollars. Would it then not mean for us consumers, the products, the imported products specifically in India will also get expensive, eventually leading to higher inflation?
Well, we are faced with the Hobson's choice in the sense that any depreciation would have its impact on the price level, depending on how much of sort of import that you are going to do. But at the same time, if you don't, adjust your exchange rate to the market, then obviously your current account deficit will go up. Your trade deficit will go up. The major reason why we have today this type of a situation is, I still do not, I'm not very convinced that the interest rate differential is all that a major thing, because even if you see April outflow, it was the outflow of dollars from the foreign institutional investors. It was just about 2.36 billion, whereas your trade deficit in May was almost 24 billion. So it is an important factor, but at this particular moment of time, it is important, even otherwise, to begin with, we had an overvalued exchange rate. Over a period of time, they have been protecting the exchange rate, but, over a period of time, we have got to adjust it to the inflation, because you can't afford to have, as it is estimated that we are going to have a current account deficit of more than 3%. So we can't afford to have that sort of a situation. We need to really make our system more competitive. Exporters, obviously, falling rupee will help the exporters. And, you need to, ensure that there are adequate exports. And therefore, we need to really have that. It would have some impact on inflation, but at the end of the day, you need to see the total effect of everything. And then obviously, may adjust your exchange rate.
Dr. Rao, when you say we, in any case, had an overvalued exchange rate, what should be the correct level of rupee? Is there any way to predict it? Is there, should RBI have a level of rupee that it should maintain against the dollar? Does RBI have such a level that it always keeps an eye on? Because we have seen Reserve Bank of India intervening as well many a times.
Absolutely. Every central bank has to have a look at things. But then there are global uncertainties, as was told by all others. Obviously, we didn't expect that, so Russia will invade Ukraine and there will be massive disruption in the availability of oil. And, both because of the Russian invasion and the sanctions that are given. And, thankfully, in one sense, which is not a good news, but, China is not really demanding so much of oil because of the lockdown still. But if it goes up, if China relaxes its lockdown, then again there will be much more demand for oil, and then oil prices will go up further from $120. So RBI would keep an eye, but then RBI will also have an eye on what the market rate of exchange would be. And based on that, it will gradually make adjustment. It will not make sudden adjustment. But these disruptions have come on a sudden. And you may recall, even in 90, when we had got into the crisis, the major reason, when, of course, we had a bad fiscal situation. On top of it, what happened is that Saddam Hussein decided to invade Kuwait, and the oil prices doubled. And as the oil prices doubled, everything, sort of your current account became problem. Rupees started flying out. So dollars started flying out, and you had only 3 weeks. The stock was just about 3 weeks import. Now, so obviously there are a number of issues there, but then the fact that it would raise the prices should not prevent us from getting our exchange rate right.
Okay. Mr. Ahluwalia, I remember in 2013 as well, we were in a similar sort of a situation. Rupee was on this sort of free fall mode, and there was one news that actually stabilized the rupee suddenly, and that news was about Mr. Raghuram Rajan being appointed as the Reserve Bank of India governor. Do you think something like that can also happen this time? I'm not saying specifically about, having a new governor, but news from the government side, do you think something like that can again stabilize the market in terms of economic reforms, in terms of, some sort of an assuring statement from the Reserve Bank of India governor himself?
Yeah, I mean, Raghuram Rajan is, of course, a star. He's a global star. And there aren't too many of them around India. Unless you're proposing that we get an international star who will infuse confidence in the market. I mean, the UK did that with a Canadian governor. So maybe we can think of it, but I don't think we're ready for that. So, at the moment, I don't believe that just because the rupee has depreciated, it should feed into inflation, because there are a number of levers with government which it has not used to control inflation at home. And one of these is to reduce import taxes. We have been increasing import taxes at a time when the world was a very certain place, and it seemed like a good thing to do for Atmanirbharta, which is fine. But that world has changed. It's now a very uncertain place. It's a perilous place. We're standing at the edge of a cliff. And I think it's time to reconsider that entire long-term planning that we had, that we will grow domestic industry, something that we tried way back in the 80s also and did not succeed at. But in any way, in the short term, I think that import duty should come down, import levies should come down. That's number one. The number two is that, don't forget, even on oil, there is a lot of suppressed inflation still in the administered pricing regime that we implement, where we price domestic oil and gas at very low rates as compared to what it can get internationally. Now, this is a bad practice that we have not been able to get away from for years, and we must, after this crisis is over, give importance to that so that we don't have these pockets, of problems which allow us, which reduce the leverage and the game to play to actually take counter-cyclical measures. So that's the second one. Third one is, just tighten our belts. There's a great deal of wasteful expenditure going on in the government. And I'm not talking of welfare spending. I mean, welfare spending needs to be targeted better. But this sort of, mantra that capital investment is a way to go, it needs to be examined, because unless and until at the time of a crisis, the kind of capital expenditure that we do has to be to get latent projects buzzing into service so that they're actually providing an economic return, so that they're growing the GDP. This is not the time to start new projects. It's this time to complete old projects. But I don't think that is actually happening in the government. At least there's no visible sign of that. And that's what I mean by tightening our belts. I also read in the
Okay.
papers that the government has announced a seventh, pay commission for government servants, so that their salaries, which are already 100% indexed to inflation, will go up even further. I don't think the markets will look good, kindly at that. So belt tightening is a very, very important aspect of managing a crisis, and we have not seen enough of that. The business as usual way of going ahead with whatever we have planned, irrespective of what is happening in the world, does not suit a small economy like India.
Okay, interesting. In fact, Mr. Sunil Sinha, what is your view? Do you think maybe a bolder stance is needed as far as the rate hike regime in the country is concerned by Reserve Bank of India? Because so far we have seen markets reacting, positively every time there has been this monetary policy meeting. We have not really seen any sort of a sharp negative reaction after the monetary policy meeting. So do you think perhaps markets and the investors specifically need some sort of a reassurance from the Reserve Bank of India? So far, it appears they have given a thumbs up to the action of the Reserve Bank of India. But do you think some sort of a reassurance is needed to stabilize the investors, to stabilize this rupee market?
Well, in a volatile situation like we are in, particularly because of the geopolitical situation, you really cannot do much about the geopolitical situation. I mean, that you will have to take as it evolves. Yes, certainly the shock effect of this geopolitical situation can certainly be calibrated in a way that its impact on the economy is much lower. And that's what has been the attempt both of RBI as well as government. I mean, say, for example, the whole imported inflation, which is seeping into the economy, as I said earlier, cannot be wished away because we are a net commodity exporter. So we simply cannot stop importing oil and gas. I mean, we just don't have any choice but to do that. But at the same time, you can certainly recalibrate the taxation or tax structure. And government has already done that by reducing the excise duty. So to some extent, government has absorbed the shock and tried to ensure that the entire increase is not passed on to the domestic economy and in turn to the domestic inflation. On the other hand, RBI's key job is to certainly target the inflation, and that's what it is trying to do. Because let's not forget that till some time ago, RBI was being accused that it is behind the curve in terms of really taming the inflation. Even while inflation has been kind of beyond their threshold level of 6%, RBI was not seen to be doing much in terms of raising the rate of interest. And now that within a span of 1.5 months, it has raised almost repo rate by 90 basis points. Now, the talk is that how long and how far RBI will go so far as interest rate cycle is concerned. I mean, my view is that given the way the inflation is behaving, and our expectation is that the overall average CPI inflation in fiscal year 23 will be about 6.9%. I mean, of course, RBI is pegging it at about 6.7%. So if that is the scenario, then further rate hike is almost a kind of a certainty. Our view is that another 50 to 75 basis point rate hike is very much likely in this fiscal. And if geopolitical situation does not stabilizes and continues to create the uncertain environment, then it might even go up to 6%. The policy rate can rise from 4.9% to ultimately 6%. But that could happen in the next fiscal. So the net, the point that I'm trying to make here is that whatever levers both government and RBI has at their disposal, they are trying to use it to the extent possible. But the fact of the matter remains that if we are net commodity exporters, and if we are in a way price taker, we have very little option in terms of really ensuring that nothing happens to the economy. The inflation is something which we will have to live with it till the time global situation continues to be volatile.
Absolutely, and that's something that we are witnessing, almost on a daily basis. And I want to give the last word to Mr. Anil Kumar Bhansali. It seems that attempts have been made by Reserve Bank of India to stabilize the rupee, but they haven't really worked a lot. For how long do you think it can be done from the Reserve Bank of India? And what is it that you're expecting from the Reserve Bank of India in the near future? How can it slow down the pace of this weakness against the dollar?
RBI has been doing all it can do. RBI has reserves of about $601 billion, and it has about $70 billion as forward long positions. Now, these long positions plus 601 takes it to about $671 billion. So RBI has sufficient reserves to actually keep a tab on the rupee, not allow it to depreciate, but the direction it will not change. The direction will be on the weakening side unless situation globally changes, unless the oil prices come down, unless FPIs again start investing into India. All Asian currencies which are weakening again start to gain against the dollar. The dollar has just been on a up move from 93 to 105. Recently it has come down from 105 to 101, and it's again back to nearly 105. So the dollar index I'm talking about.
So the bottom line is it's definitely not a good news the way rupee is weakening against the dollar for a country like India, but we'll have to wait and watch what happens in the days from now. And also an important point that has been made, that what's happening with Indian currency is also the impact of what's happening in the global world. So we'll have to see how much more will RBI really intervene to stabilize the currency the way it is weakening against the dollar. Thank you very much, all of you gentlemen, for joining us here on Urban Debate on Mirror Now this evening and helping us understand what it means for the people of this country, this weakening rupee against the dollar. With this, we will slip into a very, very short break, but